Welcome to Objective 5 in Unit 6 in Accounting 3310. In this objective, we're going to learn the distinctive methods of accounting for long-term construction contracts. Revenue recognition of multi-year construction of products presents unique issues. Usually, no revenue is recognized on incomplete products. But what if the product is a cruise ship or a satellite that requires 2 or 3 years to build? How do accountants adapt revenue recognition principles for long-term construction projects? At the end of this objective, students will be able to recognize revenue when there's a long-term construction contract. There are 2 methods of accounting for long-term construction contracts. One is called the completed contract method. That method recognizes all profit at delivery when the title is transferred to the customer, but recognizes expected losses in the period in which they are identified. What makes completed contract method different than our regular accrual revenue recognition is this early recognition of losses. The second method is percentage of completion method. In percentage of completion method, one recognizes profit proportionate to completion, usually measured by costs incurred during production, but recognizes all expected losses in the period in which they are identified. So both of these methods recognize expected losses early while a project is still under construction. What differs between the 2 of them is completed contract still recognizes profit at delivery, which is the normal situation in usual accrual accounting, but percentage of completion allows the early recognition of profit while construction is going on. We've mentioned the criteria for recognizing revenue during production previously, but let's go over it one more time now that we have gotten to this method. We have 4 criteria. Reasonably dependable estimates can be made of the extent of progress toward completion, contract revenues, and contract costs. This means to you, you will have the fact situation to use to calculate revenue. You will need to know those contract revenues, contract costs, and be able then to estimate progress toward completion. The contract clearly specifies the enforceable rights regarding goods or services to be provided and received by parties, the consideration to be exchanged, and the manner and terms of settlement. That is, a long-term construction project must be made for a specific customer, and it must be a specific product. 3. The buyer can be expected to satisfy its obligations under the contract, principally payment, and the contractor can be expected to perform its contractual obligations. That is, this must be a long-term construction project that we know that the contractor is going to be able to complete. We're going to study first the percentage of completion method. The first principle here is that profit is recognized proportionate to the costs incurred in production. Profit proportionate to cost is preferred, but it is possible to measure profit proportionate to some other measure, such as an output measure or a completion goal. We will be practicing using cost as our measure of completion. Principle 2. Losses are recognized in the period in which they occur. The accounts used in long-term construction are specific to this kind of industry. We're going to call the inventory account construction in process. That inventory account accumulates all the costs of manufacturing, raw materials, direct labor, and overhead. But there's going to be something distinctive here, because when profit is recognized during production, it triggers a revaluation of inventory, and the profit that's recognized on the income statement in double entry accounting, an increase in a credit, also has to increase some debit. Well, the debit that it increases is it increases the value of the inventory. So as revenue is recognized, that profit increases the inventory account. The second distinctive account is billings. This is a contra asset account as a contra account to construction in process. Because during long-term construction, often these contracts require the customer to make periodic progress payments. These periodic progress payments, thus, are a way of transferring little by little ownership of the project over to the customer. And so the value of the inventory on the books of the seller is construction in process less billings, the portion of the inventory account that the customer has not yet been charged for. The third distinctive account is gross profit on construction in process. Gross profit on construction in process is calculated at the end of each period, the proportion of total gross profit that can be recognized based on the costs incurred to date. This is the amount that's recognized on the income statement and that increases the inventory account. Revenue on construction in process is a derivative figure. When we add together the costs of construction plus the gross profit, we calculate what revenue is going to be. The implementation here is that any gross profit recognized before sale represents a revaluation of inventory. Thus, when we recognize that gross profit, we increase gross profit and increase in owner's equity, that's a credit, and we increase the asset of inventory, here called construction in process. Profit on construction in process is operating revenue for the period. For example, a company is 40% complete on its construction project in 2002 with a $100,000 two-year job with an estimated total expense of $80,000. The profit on construction that's expected is $100,000, the amount we're charging the customer, minus the $80,000 it's going to cost us to construct. So the total gross profit is $20,000. The percentage complete in 2002 is 40%. So the gross profit that can be recognized is the $20,000 total gross profit on project multiplied by 40%, or $8,000. Gross profit on construction in process in 2003 will have two steps associated with it. We'll calculate the total gross profit. Here it's still $100,000 minus the $80,000. We're keeping things simple at this point, that there's no change in contract price and our estimate of costs was accurate. At the end of a construction process, it is 100% complete. So the total gross profit as of the end of this project is the $20,000 times 100%, or $20,000. The gross profit that can be recognized in 2003 has to take into account that some of that gross profit was already recognized. We can't recognize all $20,000 in 2003 because that would double count some of the gross margin. We recognized $8,000 in the previous year, so we need to subtract out the gross profit already recognized from the total gross profit, and $12,000 in gross profit is recognized in 2003. In this case, you would get the right answer in 2003 if you took the total gross profit on the project and multiplied it by the additional percentage complete that occurs in 2003. That is, you'd get the right answer if you multiplied 20,000 times 60%, since it was 40% completed in 2002 and 60% completed in 2003. However, this shortcut almost never is appropriate in practice, because the simplifying assumption that we have here, that we were able to exactly estimate the costs ahead of time, is never going to actually be true. So whenever we have a change in estimate of the costs, we are going to have to do the two-step process of first calculating the total profit and then subtracting out the profit already recognized. Here's a table that lays out the process for calculating, for calculating the profit on construction in process. It takes it step by step, and I've used the labels on the rows to help you identify the calculations that are done each time. In this case, the costs incurred in the first year are $32,000. In row B, I total up the total costs incurred. So in the first year, it is just the $32,000. If we look over at 2003, costs incurred in the second year were $48,000, and the total costs incurred are the sum of the costs incurred of 2002 plus the costs incurred in 2003, or $80,000. Then in 2002, in row C, we have to estimate the additional cost to complete. Our estimate in 2002 was an additional $48,000. That means in D, we can come up with the total cost of $80,000. Now look at 2003. Row C there is 0. That's because when a project is complete, there are no additional costs to complete. However, the calculation of D is the same. It is still adding up row B plus row C. It's just that C happens to be 0. Row E is given information. What is the contract cost? Here we're going to assume it remains the same across these two periods. That now gives us enough information to calculate our percentage complete. B divided by D. So it's the total costs incurred so far divided by our total estimated costs. So in 2002 we're 40% complete, in 2003 we're 100% complete. In G, we can calculate what the total profit on the contract is. That's the contract price minus the total estimated costs in D. And here in our simple case, that remains the same at $20,000 in each period. Now in H, we finally are ready to calculate how much gross profit there is on the contract so far. In 2002, the gross profit is $20,000 multiplied by percent complete 40%, or $8,000. In 2003, we're completely done with the project, so our gross profit of $20,000 is multiplied by 100% to give us $20,000. In row I write down how much profit has already been recognized. In the first year, nothing was recognized previously, but in the second year, $8,000 had already been recognized. Then I subtract out the amount that has already been recognized to find what needs to be recognized this year. This process, this table with its formulas, is going to help you to calculate the gross profit on construction and process, even if we have one of the more complex situations in which there are actually changes in estimates. Let's evaluate the solution. The sum of the profit recognized in each year must add up to the difference between the contract price and the cost of the project, so you can check yourself. Our conclusion was that there was $8,000 in gross profit in 2002 and $12,000 in 2003, and sure enough, that adds up to $20,000, which reconciles with the difference between the contract price and the total costs. The second thing to evaluate it is, in the last year of the life of a project, it must be 100% complete. If you have any other percentage complete, there must either be another year in which construction continues, or you have an error in your sheet. On the income statement, one can either recognize the gross profit directly, that is the $8,000 in 2002, and the $12,000 in 2003, or one could recognize the revenue and the cost of goods sold separately. The cost of goods sold is the amount of costs that occurred during the period. We have that on our table in row A. It's $32,000 in 2002 and $48,000 in 2003. We calculate revenue by adding together the cost plus the gross profit. So in 2002 we get $40,000 of revenue, $32,000 of cost of goods sold, for a gross profit of $8,000. In this objective, gross profit is calculated and then revenue is derived, knowing costs and gross profit. One can derive revenue first, but it is a more complicated calculation and requires additional analysis, and so this becomes a much more straightforward way to complete every one of these problems accurately. Let's think about what appears on the balance sheet now. Here's a T account for the inventory account of construction in process. It starts out at 0, and the $32,000 in costs that happened during 2002 increase inventory. That occurs on the left side. It's a debit. An increase in an asset is a debit. Then when the profit is accrued, it increases construction in process, so that the balance at the end of 2002 is $40,000. The profits in the costs in the next year are $48,000. That gets added in, and then we add in the gross profit from 2003, which is $12,000. So at the end of 2003, the balance in this account is $100,000, exactly equal to the contract price. That is not a coincidence. That is what will always be the case. We will be adding the costs and the profit to the inventory account, so that at the end of construction, the value in the construction in process account is exactly equal to the contract price. Then, when the goods are transferred over to the customer, we'll decrease construction in process and leave us with a zero balance in inventory. That's our normal sales transaction when we decrease inventory at the time a sale occurs. Customers are often billed during construction on long-term construction projects to aid in the funding of the project and to minimize borrowing costs to the builder. Amounts charged to customers are not related to the amounts that are accrued in construction and process account. To the extent customers have paid ahead for a project, some of the ownership rights in the project belong to the customer, and the builder's net asset decreases. Let's take a look at the journal entries that would be written if we assume that the customer was billed $50,000 in 2002, $50,000 in 2003, and actually paid $25,000 during the year 2002, and the other $75,000 in 2003. When the costs are recorded, they increase the inventory account and represent a cash outflow or perhaps a trade payable. When we send the invoice to the customer, it creates an accounts receivable, but the other side of the account is called billings. That's that contra construction in process account that we talked about many slides ago now. So when we bill the customer, we do not have a sale take place. Instead, we have transferred over some ownership in our inventory to the customer, and we use the account called billings. At the time of a customer payment, it's our normal transaction in which we increase cash and decrease accounts receivable. At the end of the year, we record the amount of profit to be recognized as an increase in the inventory account construction and process, and an increase in gross profit on construction and process, which is an account that shows up on the income statement. Here's the next year. We have the same journal entries as previously, but now with different numbers taken from our table. What's distinctive is at the very end of the project, when we're going to transfer it to the customer, we're going to take the inventory off of our books at the contract price of $100,000 and take off of our books billings at $100,000. At that point in time, when we transfer it to the customer, we have already recognized all of the gross profit on construction in process. Here's an overview of the journal entries that we use. Materials, labor, and overhead that are used in production result in an increase in inventory and a decrease in cash or a liability. When the customer sent a bill, that is an increase in accounts receivable and an increase in billings. When a customer pays the bill, that's our normal increase in cash, decrease in accounts receivable. During the fiscal period when we have a profit, we're going to recognize the profit by increasing inventory and by having an increase in owner's equity. If we have a loss, which we have not illustrated yet, we are going to decrease inventory and decrease owner's equity. So it's exactly what you would think would happen. when the project is completed, will accrue any final profit to be recognized, and then transfer the title to the inventory over to the customer by decreasing inventory and decreasing billings. The financial statement effects are that on the income statement, we recognize revenue during production. So even though this isn't completed until 2003, gross profit of $8,000 is recognized in 2002 and $12,000 in 2003. On the balance sheet, there'll be a current asset for accounts receivable for the amount that we've charged our customers, and we'll have the difference between construction in process and billings. Here we have construction in process of $40,000, billings of $50,000. So it actually is $10,000. The customer has been charged $10,000 more than the contract. That means we actually are in effect in a credit balance for this amount. That means it's going to be recognized as a current liability rather than as a current asset. If at this point in time we liquidated and were unable to finish the project, we would owe the customer $10,000 plus handing over the project to them. On the balance sheet in 2003, the project is sold and fully paid for, so there are no balance sheet effects at that point in time. Let's take a look a little more deeply at this billings account. Billings is the contra asset account to construction in process, and the two accounts are associated and expressed net on the financial statements. If billings are larger than construction in process, like we have in this example, then the company has a liability of billings over construction in process. If construction in process is larger than billings, then the company has an asset. Here, let me make up some numbers. If we have construction in process of $40,000, but we had only billed $25,000, then the net construction in process would be $15,000. That $15,000 would be a current asset showing up on the balance sheet. Now let's let you practice what we've just learned about percentage of completion. This company has been contracted to build a warehouse for $150,000. It expects that the cost will be $100,000 to complete construction. Assume that the cost incurred were expected in the previous year. We have costs incurred this time of $40,000 in 2002 and $60,000 in 2003. We have equal billings in each year, and we have the payments that were given. Based on this information, here's a template for you to complete to follow through the process of calculating the amount of gross profit to recognize in each year. Pause right now and get out your calculator or copy this into a spreadsheet, and when you're ready to go on, pause this video. When you're ready to go on, see if your solution matched my solution. Here's my solution to this problem. You can track through each of these numbers and each of these formulas. The bottom line here is that there will be $20,000 in profit to recognize in 2002 and $30,000 of profit to recognize in 2003. If you had difficulty getting this number, track through these lines one at a time and see if you can see what went wrong. The journal entries that you would write next are based on the numbers you've just calculated in that table. Pause right now and write out your journal entries, and when you're done, unpause this video and take a look at the journal entries that I have written. Here we have, for the 2 years, recording the costs, recording billing the customer, recording the customer payment, and recording the gross margin on construction in process each year. In the second year, we also have added in the transfer to the customer. What are the financial statement effects of this project? Can you tell what's going to go on the income statement and the balance sheet? Pause until you've gathered the information. On the income statement will be the gross profit on construction in process for each year. on the balance sheet will be the accounts receivable for the amount charged the customer, and then a net amount of either billings over construction in process or construction in process over billings. This is another example where we have billed the customer more than construction in process, so it represents a current liability. We're going to pause right here. You've done a lot of work so far on construction in process. We are now going to introduce changes in estimates. We'll wait until you feel comfortable and solid on the skills you have so far, and then we'll pick up with the other half of this objective.